Hello, in this presentation we will adjust our beginning account balances within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. We will be continuing with the Get Great Guitars. If you've been continuing with us, that's great. If not, that's okay. We will be adjusting the beginning balances, something that needs to be done anytime we enter new opening balances into the QuickBooks program, because QuickBooks, while allowing us to do that without having journal entries, enter beginning balances into accounts, that is, it then needs to put the other side somewhere, and QuickBooks will basically just decide where to put that. And we might need to adjust that. There's going to be some accounts that we'll be able to see that will be obviously adjusting accounts, and we'll see what we can do with those accounts. First, let's see some reports so we can see what we are talking about. So we're going to go down to the reports here, and I'm going to choose a report that's a little bit more of an accounting report, which is the trial balance, but it shows all the accounts. It's kind of like a list of accounts, although it does have debits and credits included. So here we will go to the trial balance here. There it is. So we're taking the trial balance. That's what we're looking for. And we will run this report. Now remember, we're working as of 2021. That's going to be when we entered data, January 2021. And we entered all the beginning data for the day right before that. So what we're going to do is run the day right before the period in which we're going to start entering transactions, January 1st, 2021. So we want to look at 12/31/20. 12/31/20 and run that report. So we got 12/31/20. This is when we entered all of our beginning balances because we expect to start entering data the first day of January 1st, 2021. So we have our beginning balances, and most of these, all we did here was to put a beginning balance in the checking account. And that's only one side of a transaction, so QuickBooks must have done something somewhere else. And same with the accounts receivable, we only did customer balances here to get this balance. We just entered customers and their balances, and QuickBooks must have done something else in order to make that balance. Inventory, all we did was enter items of inventory and the amounts we have, and QuickBooks put this number here, and that must have done something else. Furniture and fixture, we put in the beginning balance for furniture and fixture, and QuickBooks must have done something else. Accounts payable, we put in beginning balances for the vendors that we put into the system. QuickBooks must have done something else. Visa, we just put in a beginning balance, so that's only one side of a transaction. QuickBooks must have done something else. And then we have the loan payable, we put in a beginning balance. And then we're down to the equity section. And we see here we didn't do anything yet to equity. We didn't do anything to equity, yet we have this equity account, opening balance equity. That's clearly going to be part of the transaction that QuickBooks did in order to make this work. So we have that account. So this account's not typical. We don't really want that account. QuickBooks is just basically saying, hey, this is our opening balance. This is what we did in order to allow you to just put in these beginning balances and not have any adjusting journal entry in order to do that. And then we have sales, and we have other miscellaneous expenses, two other items, which once again, we didn't actually enter anything into sales or other miscellaneous expenses. The QuickBooks is putting this on the other side of the transaction for, it looks like, accounts payable and the accounts receivable when we created those. So when we put in other words, the customer balances for $20,500, QuickBooks said, let's just make invoices for that. And that's how we're going to put the other side together so that the debits equal the credits. When we put in the $15,000 to accounts payable with vendors that owe us money, QuickBooks said, maybe the other side is just going to be some type of expense. So that's kind of okay, because as long as these two amounts are temporary accounts, they're going to go away as of the first day of the year that we're actually going to be working on, which is January 1st, 2021. So we really want these two to go away. They'll roll into whatever our equity account is. These are temporary accounts. So let's just see what happens if, for example, we go to the first day of the next year. So I'm just going to hit +1. We're now on January 1st, 2021. Plus, and now we're on to January 1st, 2021. Let's run the report. And here we have our information now. Now we've got the opening balance here, and those two other accounts, the revenue and expenses, are closed out to just retained earnings. So that's where we want it in essence. Retained earnings is more of a corporate account rather than having a equity account for a sole proprietor, but it works in the same way in essence. So now we just have this one account which represents the book value of the company, and then we have this other account which QuickBooks just made up to make the debits equal the credits. So it's a permanent account. Notice it didn't go away. It's not an income statement account. It's a balance sheet account, in other words. And so what we want to do is just close this out to retained earnings. Really, this is part of retained earnings for us. Now, there's a couple different ways that we could do this. One is with a journal entry. That would be the typical way to do this. If we entered a journal entry, we would say that this is a credit, and we need to do the opposite thing to it to make it go down to zero. We would debit it by the $79,896, and then we would credit, making retained earnings go up by the $79,896. And that would be the journal entry we would do to get rid of basically the opening balance and put the amount into retained earnings. Because we're using QuickBooks, we could use the register functions as well, just to get used to the register functions. And note that QuickBooks is going to try to do a lot of the data input without needing journal entries. There's some places where we pretty much need to know the journal entries, even if we use the registers as we will do now. We still need to see that we have something in opening balance equity. But the registers are a way for us to try to reduce the amount of debits and credits. The more debits and credits we know, the more we can really better understand how the system's really being built. But it's good to try to work within the QuickBooks system and see the alternatives that they have to entering just journal entries. So in this case, we're going to try to use the register system. And the register system, for a check register, we're all used to a register just increasing or decreasing the checking account. QuickBooks will have a register for pretty much all the balance sheet accounts. So if we go into opening balance here and we say we want opening balance to go down by $79,896 and then just tell it what the other account is, QuickBooks will figure out then what those debits and credits are. So in order to do that, we're going to go down to accounting. We'll look at the accounting section here, and we're going to scroll down to the equity section. So it's in order by account type. We're looking, it's in assets, liabilities, equity. So here's the equity. Here's opening balance. So we want this opening balance. There's the balance we have in it. We want to get rid of that, put it into retained earnings. So we're going to select that item, view the register, and we could see the detail here. We could see our running balance. If I scroll to the right just a bit, there's our running balance, and we're ending at the $79,896. Scrolling back down and going back to the left a bit. There we have this. So we're going to add a new one. So it's going to be a journal entry format. If we select the formats, we don't have many. In essence, we're just entering a journal entry because typically we don't usually use the opening balance. So there's no normal form that would be created in order to deal with this area. So we're just going to say add journal entry. And we're going to put that journal entry at, I'm going to say the first date of the current year we're on, 01/01/21. January 1st, 2021, the first day of the year that we are currently going to be working on. And there's no payee memo. We could say adjust beginning balance. And we're not going to increase it, we're going to decrease it. So this is the key. There's no debits and credits here. We're going to say it needs to go down, $79,896. And then we're just going to put the other side somewhere. So I tabbed over to the other account, and that's going to be retained earnings. So we're looking for retained earnings. So we're going to select that one. So when we do this, this one should go down to zero, and then we'll go take a look at our report and see if the other account was retained earnings and if it does what we believe it should do. So let's go ahead and save that. So we're going to save that. And then if I scroll back over a little bit and scroll back up, it's down to zero. That's what we want. Now we're going to go to the reports. So we're going to go to reports once again. And we're looking for the trial balance, selecting the trial balance, and we're going to run the dates as of 01/01/21 to 01/01/21 and run that report. And there we have it. So we have the retained earnings here at $85,396. That looks like what we want. Opening balance is now zero. We're now ready to go forward. Notice what we don't have here are any temporary accounts, any income statement accounts, any revenue and expense accounts. That's because we need, those are going to be populated as we move forward into the current year and enter normal day-to-day transactions. So let's go now, just go ahead and export this report. So we're going to go export. and go to Excel. I'm going to export it as an Excel document. Here we have it opening up in Excel. Here is our report. So currently your default, okay, I'm going to say okay, enable, and it looks good just as is. So we're just going to say File, Save As, Browse to the location we want to put this. I'm going to put this into Excel Docs 6. I'm going to keep the name as is, so that'll be that. And there is our adjusted trial balance.